Are we about to see a 60% increase in stocks coming to a monitor near you? Just like the one right here and right here. Is that possible? Well, this is my opinion only, and past performance does not equate to future performance. But here is a chart by LPL Financial that's approved that we can show that looks over the historical bear markets and bull markets, bottoms and peaks. Let me zoom in here a little bit more. If you take a look at this, again, year by year returns, this goes all the way back to 1949, and we look at if we hit a bottom in the bear, which right now we're in what's considered a bear market. So you have a drop of over 20% from the peak, right? And then we don't get a bull market to recover all that loss and get back positive again. So you can see all these year by year returns once we recover from a bull market or from a bear market. Are we going into a bull market again right now? Are we going to average the same rate of returns roughly that past bull markets have on their first 3 years? Nobody knows, right? But here's what they've done. And this is where I'm getting to this average is 60%. Again, no guarantees, could go back down, my opinion only here. But this is, again, from LPL or FactSet, March 22nd. 41.8%, guys, right here on that first one. Then you got 13.3% on that second column of a bull market. That's the average. So it's taking all these bull market returns the first year and averages them together. Same thing for each column. And on the far right, 5.2%. If you average all those up, you get roughly 60+%. That's what I'm talking about. Well, we're going to go through some key data points that our research staff is looking at, but there's one research that I've done, in my opinion, and you're not going to see it probably in a lot of your media outlets, but I'm going to talk about it. I think it is actually one of the major backbones to why these returns could be potential coming up. No guarantees, don't know exactly when it's going to happen, but it's something I believe you can never bet against. And we're going to talk about that. And it's the last couple slides, so you got to hang in here and see that. All right, let's get into this. We talked about the bear market. We've had another one here. An interesting point on that, the far right side, you see the average bear market lasts about 11 months. Mean is about 7.2. Again, far number over there to the right. We're about 7 months into a bear market right now, officially from the standpoint of the peak of the bull to where we are now. Do we go longer, shorter? Don't know. You're seeing right now out there in the marketplace, are we in a recession? Some people think we are. You got U.S. leading economic indicators, according to the conference board, pointing towards that. Then you've got Russia, right? Says the West risks the wrath of God if we punish Moscow over the war. Things like that. Is the Fed going to raise rates? You got that coming up. They're meeting again this week. They've already raised them a pretty good amount, right? You're starting to see some slowdown in housing and stuff like that. This chart here is going all the way back to 2008, which is right here by my left shoulder. I consider these all the panic moments that are always brought in the media and what have happened. Obviously, 2008, the mortgage crisis, big issues happened there. Markets dropped over 48%. Then in 2011, right in here, we had actually the U.S. government debt, the supposed safest debt in the world, downgraded to AA from AAA. Still, the market is charged up for it. And there's a lot of other things in here. And then you actually had COVID, right? Everybody, oh my God, COVID, we're not going to be able to do anything. That recovered. So will we recover again and see that upward movement? No absolute guarantees, but let's talk about some things that we're seeing. This is our LPL's research mid-year outlook. Navigating turbulence is the kind of theme on this, guys. Got that airplane because we've been facing a lot of turbulence in the markets recently, and that's what we're going to talk about. Possible catalysts that we're going to see up here on the board. We've got evidence of cooler inflation. I'm going to show you a chart there. Fed pause possibly in the fall. You got China stimulus reopening, Ukraine ceasefire. There's some news that came out today on some possibility. Maybe that's looking like something. Post-midterm election year returns, rallies tend to be strong. Great chart there. You've got to stick around to see this. Amazing chart. And reasonable valuations. We've dropped over 20%. The key concerns are complete opposite. If we see the complete opposite of any of these things, obviously the market may continue to go down on that. But let's look at these. Here's the one about Russia, Ukraine, just came out, talking about grain exports coming together with the UN-backed deal that helps get grain exports out, because they're one of the largest producers of grain. That's why we've seen food prices, fertilizer, all this stuff skyrocketing in prices. Well, if we're starting to let these grains get out, maybe that's a helper there to get prices down. Are we in a recession? See, there's a lot of people thinking we're in a recession already. Our guys don't think we're going to get to a recession. Coming close, but not getting there. We think for the year 2022, we'll grow somewhere around 1.9 to 2.5% on the gross domestic product. What is gross domestic product? That's all the products and services produced in the United States. We're talking U.S., but it also applies to other people. Paying all that, all the receipts for that. And how much of that in trillions of dollars have we done? I'm going to show you that in a second. It's a mind-blowing number. So even if we go into a recession, which can be bad for some people because they can lose jobs and all that type of stuff, but do we recover? Let's look at this. I just mentioned that. This is interesting. So 1995, this is what the gross domestic product was in the United States and some different points in the world. $7.6 trillion, guys, for U.S. So that's production of goods and services. Japan was at 5.5. You got France at 1.6. Germany was at 2.6. Look where China was, 734 billion. Barely making it into the top 10. Well, let's look now. What do we have here? You've got the U.S. Now, and this is actually, go to 2018. So this is just before the pandemic. 20.6 trillion in gross domestic, all the gross domestic product, all the goods and services produced in the United States. 1995 was 7, roughly. So more than double, since 1995. China now, look, at 13.6. Japan's still hanging in there at 4.9, and Germany at 3.6. UK another 2.5. Watch this. 2020. Went through the COVID-19, still battling some of that now, still did 20.9 trillion production of goods and services. That's a lot. And I want to show you what that 20 trillion looks like here in a second. That is a lot of money, all right? And in 2022, we're looking at 100 trillion world economy. China's supposed to, by 2030, overtake us. We've been the number one producer since 1871, over here to the right. Here is what 2022 looks like. You've got China at 19.9. We're at 25.3%, or $23.3 trillion. If we do go into recession, let's say our production is 5% less. That takes us down, even 10% less. That takes us down to 22 trillion. That is still 2 trillion roughly more than we were during COVID-19. Is that really horrible? Yes, there's going to probably be some people that already have lost their jobs, people have been laying off, but can we recover? Are we a machine of innovators, adapters? Can we do that? I believe so. Stick around. I'm going to show you something. The next big thing that is a trend that we've seen is consumers deleverage since the 2008 crisis. They are still in one of the best positions they've been even since way back. I think it's since like 2000. So during the 2008 crisis, we were pretty highly levered from a percentage standpoint compared to normal. And then look at this, we dropped like a rock on that roller coaster coming down the big hill, and we're still over here to the far right really low. So the The consumer is still in a great position financially, not a lot of debt load out there. That's why we don't think this is a 2008. Banks were much stricter in their lending, even though there was a lot of money put out during COVID. And speaking of that, we're going to talk about that here right now. How much money is sitting in cash right now? I'm going to really blow this up. 3.2 trillion more in checkable deposits. All right. On March 31st, 2022, than at the end of 2019 before the pandemic. Money market assets, so still liquid type assets, 1 trillion above December 2019. That is a lot of money. Here's a chart from the Federal Reserve, St. Louis Fed, showing that same thing. 4 trillion line here, look all the way over there. That's where we are now. This goes back to 1988, guys. Look at this. 1988, we are at the highest levels of cash that we've ever seen sitting out there. What if things start going positive? What's going to happen to that cash? Is it still going to stay there? Or are people going to maybe invest it? Well, here's what $1 trillion looks like. So here's a single $100 bill, right? Here's 100 of those $100 bills equating 10 grand. That's a stack of that. Here is $1 trillion worth of $100 bills in front of the White House. Let me show you an above shot. And by the way, these charts, a lot of these charts I'm showing you are coming from visualcapital.com. You've got to take a look at them sometime. They got some great charts, great visualizations, put everything out there. I'm trying to see if I'll put that link down in the bottom so you can get access to these charts and go see their other charts. Fantastic charts. So that is huge. So you've got 1 trillion right there in front of the White House, about 60 yards worth of a football field all the way down. You can't see it, but there's also actually you can see it on this one. There's that big old semi truck over there full of them. Multiply that times 4. That's how much cash is sitting in money markets right now. That's a lot of money. So the other thing is business backlogs decline as China reopens. So that's another huge thing that we're seeing, and that's been the big issue. Possibly creating part of the inflation is that supply is not there to meet the demand, especially computer chips that pretty much drive everything we have, from these laptops I've got to iPads to iPhones to cars to refrigerators now. It's like insane. That we're starting to see backlogs come down. As you can see, that far right corner. And then the inflationary numbers. We're getting some inflationary numbers that you're not seeing yet, but you got lumber down over 15%. Usually these orders, the backlog orders, there's a delay with inflation coming down. So we think that's going to be the case. We think we're going to see a drop. And this is kind of the valuations that we're looking at here on this board. Right here, this shows you the price to earnings ratio of the S&P 500, the top 500 stocks in the United States. And I think right now it's around 15, somewhere in there. And we think inflation is going to land somewhere in here, 2 to 4% over the next couple years, which means you really got a valuation of a stock's probably closer to 18, which really puts the valuation of a stock market on the S&P 500 somewhere around 4,300, as you can see, to 4,400 at the end of this year, we think. So that's about a 10%, 12% adjustment from here. Obviously, no guarantees, may not happen. But some technical things that kind of back this too are, and technical, I mean, is people like to look at technical analysis of stock prices. So there's a lot of these different inflection points, whether the markets when they're going up or coming down, that may signal different directions. And this chart is incredible. And there's actually the next few are really, really incredible. This is one of the worst quarters, though. This past quarter, you had March through June in the market. It was down greater than 15% just in one quarter. That's only happened a handful of times, basically, since 1946. But these bars here, the yellow, the blue, and the lighter blue, are what you got to pay attention to, because when you ever have a down quarter of over 15%, the next, and I'll blow this up more so you can see it, the next quarter, the average is up 6.2%. Then you've got that 15.2% bar over there for the next 6 months, and then 26.1% the next year after you have a bad quarter like that. And to back that up, there's been 5 times since 1932. That's through the Great Depression, guys, that you've seen the market down over 15% at the end of June. 5 times. 32 is the worst, down 45.4%. We didn't have all your FDIC, the Social Security, all the kind of what I call, hedges that now are in place socially for people in case unemployment insurance, all that. I can't guarantee anything. May not see that again, but you obviously could, but likelihood I think is a lot less. But if you look at this, 5 times that the market has been down at the end of June, every single time the market is up the rest of the year. 5 out of 5. So I've shown you before, there's one coming up, it's 18 out of 18, but this is 5 out of 5. Average upside, 23.7%. Mean is 15.3. See what happens here. The other big thing is midterm elections, guys. So this is incredible. This goes back to 1950. 18 times after the midterm election, the following year after the midterm election, stock market's been up every single time. The average of all this in here is 14% up. Will we get that again? No guarantees, but midterm elections usually after that have sparked things. And the other big discussion is, what's going to make up the Congress from a Republican to Democrat or whatever. Right now it's pretty split, right? You got the House controlling by Democrats, got the Senate is pretty much even, and the Senate basically is the final straw on a lot of legislative items. So we maybe are not even going to see that change much again. And that's usually right here is when you have a Democratic president, Republican Congress is the best mix. So that's very interesting, which is average over 15%. And one more chart that backs that up, or at least an interesting midterm year of the presidential cycle. The average drop in a midterm election year is 17.1%. And then the recovery is 32% on average. A lot of things lining up here technically that, and including the bull market thing I showed you. And this is the next thing I want to show you that I think is the backbone that people aren't talking about that could be the major rocket fuel that would drive markets higher. Again, this is my opinion only. This is not LPL's opinion, and it may not even happen. But the most new patents, top 25 companies with the most new patents in 2021. Take a look at this. Patents, guys, that's innovators. They're looking at generating new ideas, new technology, new healthcare stuff, research to maybe cure different diseases, which, God, I hope we can get that in many things. Look at this. Just in 2021, 327,000 patents, utility patents. And this is coming from, give credit to this. This is, again, visualcapitalist.com, but also in here it's from, source down here on the bottom or far right corner is the Patent 300 by Harity Patent Analytics. Got to give them kudos on this information. And then visualcapitalist.com putting this together. IBM, 8,540. Got Samsung over there, 8,517. Apple's up there, 2,591. Just heard a big thing about Apple. Again, this is not a stock recommendation, but talking about CarPlay, and they want to get in and get some new technology there. Then you've got my earbuds coming off. But Sony 2624, Microsoft 2540 or 2453, a lot. 300 plus thousand patents, guys. What if just one of these hits? Just one in the next year or two. Do you remember this? Look at this. I know you can't. I'm going to move my computer out of the way. Actually, but it says 2007 down there. Here's Tesla 03, Facebook 04. Didn't even have Facebook 18 years ago, right? Basically, Google Maps. Remember, you're driving around with all those long map things, the paper stuff, and flipping it. YouTube. That 2007, you know what that was? The iPhone. The thing that I'm using. I know a lot of people are using it. A lot of people using Android. Then in 2010, right there is the iPad. I'm using the iPad right here to control a lot of these swipes and stuff. We couldn't even have done this 12 years ago. Is that insane? Just think of what the next 12 years might bring. Again, no possibilities, but all those patents and people in garages thinking of ideas. Whew. That's why I don't like the market time, because if something like this happens, we might do it with a teeny tiny bit of client portfolios, but for the most part, we're investing our clients in different buckets of money. If you want to know how we handle our clients' money, especially in these kind of environments, give us a call. I got a contact information coming up here. And maybe there's some kind of ideas that you've never heard of. We'd love to have a shot to be part of your financial board of directors. Just get on there. Still keep your other advisors, bring us on, and maybe we can think of something for you. But anyway, if you just stayed in the market since 1990 and invest in the S&P 500, average of 9.9%. If you just missed the best 5 days in 10 days, you actually had a negative rate of return, if you can believe that. It's insane. And it's evidence is, again, I showed you that bull market scenario that can happen. So we really strongly believe on the stock side that you got to have, to us, really a 5 to 10 year horizon. And we can talk about that when you call. But the average rolling 10-year periods, 5-year periods, is your success rate, even in 1-year periods, 74% up. And over 15 years, it's actually 100%. There's never been a negative period in the stock market since 1950. All right, guys, contact us if you want. Back this up. 513-641-6307. You can text us at that number there. Email us. Go to pursuefinancialfreedom.com here at the bottom, and we can actually get you, if you go in the upper right corner, there's a tab called Complimentary Plan. Click on that, and we fill out the information to get you access to a complimentary consult for 30 minutes, and maybe there is something we can actually help you out with. So with that being, I'm going to roll wow, I am big there. I'm going to roll our disclaimers here going up. Until the next time, have a good one. Thank you.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight. I see you broken and beat, head pulled down over your eyes. Every part of you wants to surrender, darling, you were meant to survive. With every star